Today on Stock Predictor, we're diving into a topic that a lot of investors are struggling with right now, and that is the temptation to buy the dip on certain stocks just because they're falling, just because they look cheap, just because they dropped 20 or 30% and people instantly assume that means they're on sale. But the truth is, some dips are not discounts, some dips are warnings, some dips are traps, and today we're going to talk about the stocks you absolutely should not rush into buying just because they're down. A falling stock isn't always an opportunity. Sometimes it's a red flag waving at full speed, and if you ignore it, you can end up holding a position that keeps sinking month after month. And this is something that so many investors misunderstand. Buying the dip only works when the fundamentals remain strong, when the company is facing short-term pressure, when long-term outlook hasn't changed. But if a company's earnings are declining, if debt is rising, if management is making bad decisions, if the industry is changing in ways the company can't adapt to, then that dip isn't a buying opportunity, it's the early sign of a trend you don't want to be part of. And the first stock category we need to talk about is the overvalued tech names that ran way too high during hype cycles and are now correcting back to reality. These are the companies that investors loved at any price, companies that had massive social buzz, huge expectations, viral storylines, but very little actual profit. And now that markets are tightening and investors are demanding real numbers instead of dreams, these stocks are taking hits that aren't temporary, they're structural. You see this pattern over and over again. A stock goes from $30 to $80 on pure excitement, no revenue growth to support it, and then suddenly drops to $50. People jump in thinking it's a discount, but the fundamentals still don't make sense, and then it drops to $40, then to $30, and investors finally realize they didn't buy a dip, they bought the beginning of a downtrend. And this is happening across multiple sub-sectors: AI small caps with no real competitive advantage, speculative software names burning cash at insane rates, companies whose valuation depended on zero interest rate conditions that no longer exist. Another category you should avoid buying the dip on is the heavily indebted consumer brands that are getting hammered by inflation, rising costs, declining demand, and shrinking margins. Some of these brands look cheap on the chart but expensive on the balance sheet. When debt is high and cash flow is shrinking, you don't buy dips, you analyze survival risk. If cost pressures continue, if refinancing becomes more expensive, if brand loyalty keeps dropping, then these companies aren't temporarily down, they're fundamentally deteriorating. I see so many retail investors look at a stock that used to be $30 and is now $8 and think that automatically makes it a bargain. But a stock can go from $30 to $8 and still be expensive if earnings are collapsing faster than the share price. A cheap price doesn't mean a cheap valuation. That's the trap. Now let's talk about certain EV companies, because this sector is full of dip traps. Not the strong players, not the ones with real production and real demand, but the smaller ones, the hype-driven names that raised billions but still can't manufacture profitably. These companies fall 15% and people scream, buy the dip, but the reality is that industry competition has intensified, margins are under pressure, consumer demand is shifting, and the cost to scale is higher than ever. When a company's entire business model depends on raising more capital just to survive, dips don't represent opportunity, they represent dilution risk. And that's something too many investors ignore. Then we have the pandemic-era favorites, the companies that thrived during lockdowns but now can't recreate the same level of growth. This isn't temporary decline, it's a rebalancing. When a sector's peak growth was artificially inflated by an unusual event, you don't buy dips expecting the past to return. The world changed, the demand changed, and some of these companies haven't figured out how to grow in a normal economy. Their dips are reflections of reality catching up, not opportunities waiting to rebound. Another major category you should avoid buying the dip on is companies undergoing major business model uncertainty. When management keeps shifting strategy, when revenue streams are unclear, when the turnaround plan isn't working, those dips are warnings. Strategy confusion is one of the most dangerous signs in investing because it means a company doesn't know how to grow forward. Investors often underestimate how long turnarounds take. A business can stay depressed for years while trying to reinvent itself, and many never fully recover. Buying the dip in these situations is basically betting against history. Next, let's talk about stocks facing serious regulatory risk. These are the companies that look cheap because they're under investigation, facing lawsuits, potentially losing licenses, or subject to government intervention. And one mistake traders make is assuming regulatory fears are overblown. But when a company's entire business model depends on regulatory approval, a dip is not something to rush into. It's a situation you wait to see how it unfolds. If a company's risk increases faster than its ability to adapt, those dips are justified. And you don't want to be the investor buying during uncertainty only to watch the stock fall another 30% when new information comes out. Another kind of stock to avoid dip buying is companies with collapsing margins. Revenue might still be growing, customers might still be buying their products, but if margins are shrinking every quarter, the underlying business model is weakening. A dip on a stock with declining margins is usually a sign of future earnings pressure. And earnings pressure leads to lower valuations. Lower valuations lead to lower stock prices. That means a dip isn't a bargain, it's the market adjusting to the company's new reality. Now we need to talk about companies where insiders are heavily selling. When the CEO, CFO, and board members are all selling their shares during a dip, what does that tell you? Insiders know the long-term outlook better than anyone. And if they aren't buying the dip, you shouldn't either. Retail investors often ignore insider selling because they convince themselves it's unrelated, but patterns matter. When insiders don't believe in the rebound, you shouldn't gamble on one. Another dip investors should avoid is companies issuing repeated downward guidance. If a company keeps lowering its expectations every quarter, that means management does not have control of the business. That's not temporary volatility, that's fundamental weakness. When the outlook becomes increasingly negative, dips aren't accidental, they're deserved. And waiting for confirmation is far safer than trying to catch a falling knife. Now let's discuss hype-driven social media stocks, the names that trend online but don't produce consistent revenue growth. These companies can soar quickly but collapse just as fast. And dips in these stocks are extremely misleading because the price often reflects sentiment, not business strength. Buying dips in hype stocks is like trying to time the emotions of the crowd, and that's a losing game. Sentiment can shift overnight, but you're the one left holding shares that don't recover for months or years. We also need to mention companies with technological disadvantages. If a business is falling behind its competitors in innovation, market share, production efficiency, or product quality, those dips reflect a real risk. Markets reward companies that lead, not ones that catch up. And catching up in tech isn't easy. It's expensive, unpredictable, and often too late. Buying dips in companies losing technological relevance is one of the biggest mistakes long-term investors make. Now, the truth is this: you should only buy the dip when the story remains intact, when the decline is emotional rather than fundamental, when the business is still strong. For the stocks we're talking about today, the dips are not emotional, they're structural. They represent deeper issues that the market is pricing in. And ignoring those issues because a stock looks cheap is one of the easiest ways to lose money. So let's summarize the mindset you should use. Don't buy the dip on stocks with weakening earnings. Don't buy the dip on stocks with high debt and low cash flow. Don't buy the dip on companies losing market share. Don't buy the dip on companies with unclear futures. Don't buy the dip on hype stocks with no real profits. Don't buy the dip on companies facing serious regulatory dangers. Don't buy the dip on companies where insiders are selling. Don't buy the dip on brands whose core demand is shrinking year after year. Not every drop is an opportunity. Some drops are warnings the market is giving you for free. Because here's the truth: long-term successful investors don't just look at price, they look at direction. They look at health. They look at growth potential. A stock can be down 50% and still expensive if its future is deteriorating. And a stock can be near all-time highs and still a great buy if its future is expanding. Buying the dip isn't a strategy, it's a tool. And tools only work when used correctly. So the next time you see a stock collapsing and you feel that itch to grab it because it's cheap, pause. Ask yourself, did the company get better or worse? Is the future brighter or darker? Are the problems temporary or long-term? Because the wrong dip can trap your money for years. But the right dip, the well-timed, well-researched dip, can set you up for massive gains. Your job isn't to buy every dip. It's to buy the right dips. And avoiding the wrong ones is just as important as finding the right ones. And that's why you've got to stay smart, stay patient, and stay disciplined. And of course, thanks for watching Stock Predictor, where we break down the truth behind market moves so you can invest with confidence.